I'd like to thank everyone for joining today and just do a brief introduction to this series. So for those of you who know Mills Reeve or have worked with us will know that we have a strong sector presence in real estate investment, not only in Main Street investments, but also in alternative assets. And by that, I mean beds and living, sci-tech, healthcare, higher education, investment through finance, mobility and sustainability, and the topic for today, strategic land. However, we're not only looking at those alternative assets, the other things we look to monitor are emerging themes of investment in the market. And the one that's been very prevalent in the last 18 months and certainly on our radar is that of patient capital, which is how this series came about. So we're going to be running a series of 4 webinars on the sofa, albeit a virtual sofa. The first of them today, I'll be joined by Nigel, who you'll see on your screen. Nigel Hugill is the Chief Executive of Urban&Civic. The second is next Wednesday, kicking off at 10 AM on the stewardship model, where I'll be joined by Gail Mayhew of Smart Growth Associates and Charlie Dugdale of Knight Frank. The third, the following Thursday, the 11th of March, again at 10, where we'll be discussing investment or the institutional investors' approach to patient capital investment. And there I'll be joined by Charles Staveley, who's our Head of Real Estate Investment at Mills Reeve, and also Anna Rule, the Head of Real Assets at Railpen. Before concluding this series on the 18th of March, again on the Thursday at 10 o'clock, with a discussion around patient capital in the world of colleges, rural estates and overseas investment, where I'll be joined by Ian Keys of Bidwells. But before we start, just a little bit of housekeeping. This is being recorded, and therefore after the event, we will send all of you a link to the recording should you wish to listen to us once again. There's also a Q&A function. So at the bottom of your screen, if you were to hover your mouse over the ribbon, please do feel free to pop any questions in there. I'll do my best to weave them in to my discussion with Nigel. And if we don't have time to get to all of them today, Nigel's very kindly agreed that after the event, I can impose upon his time to get you answers, and I'll pop individual responses to those of you who raise them. And lastly, on the housekeeping, when you come to log out of this webinar, which is not yet, but it will be in about 40 minutes, there'll be a questionnaire that comes up for feedback. I really appreciate feedback, both on the contents of this webinar, the series we're proposing to run, so I can make sure it's tailored to you, and anything else you'd like to hear from Mills Reeve. So before we get into the content of the webinar, just a few words on my first virtual sofa guest, a man that needs no introduction. I think it's worth remember, however, Nigel was one of the younger CEOs of FTSE 250 company in the guise of Chelsfield PLC, brought forward those well-known developments such as Stratford City, the basis of the Olympic Games, White City, now known as Westfield White City, and also the expansion of Mary Hill. This was the start of a long-forming partnership with Robin Butler, and he moved on then to become the Chief Executive of Lend-Lease Europe, overseeing the delivery of the Olympic Village and also the Elephant and Castle redevelopment. These provided a fantastic bedrock for Nigel and Robin to found Urban&Civic, which was founded in 2009. I think anyone that's worked with the company will agree, an extraordinary company, working on large-scale master-developed strategic sites, originally private equity-backed, before being taken public in 2014, and then earlier this year acquired by Wellcome, and a welcome injection of patient capital, which we'll come on to during the course of this discussion. In parallel with this, Nigel also has an active role in a series of other activities outside of his working day. I know he's very proud to have been involved in the London School of Economics and is the current chair of the Royal Shakespeare Company, as well as Centre for Cities. And I believe I'm correct in saying an avid Sunderland supporter.
Sadly true.
Without further ado, thank you very much for joining me today, Nigel, as my first guest.
It's a real pleasure.
I wonder if we might kick off with a discussion around what patient capital is. Now, over the last 18 months in the media, there's been various references. It's been referred to as patient capital, patient investment, patient equity, a great quote from you, a long-term value in front-end investment. But there is some discord amongst even property professionals about what patient capital is as a means of investment. So I wonder if you might tell us your view on what that should be interpreted as or is viewed as.
Yeah, I suppose that discord is a little bit reflecting some of the movements that have been taking place in the broader capital markets. So patient capital as applied with us would be essentially, let's say, 20-year money compared with conventional private equity money of probably 3 to 7 years, nearer the bottom end of that. You said in your kind introduction that when we set Urban&Civic up, we did that with private equity money because that was what was available in the market at that time, and also because of that we had to go and prove the concept, which probably the best, the clear representation of that is the Welcome acquisition, which I think will be a lockstep change of institutional money into the strategic land sector. But this broader point that we are within, or this broader driver that we're within, is the markets are very short of long annuity income, and once you get strategic land investments as we define them, and we can come on to our definition of them because it is different perhaps from where it was historically, then you create income streams that are pretty much akin to annuity products. If you look at over time, house prices are essentially, particularly in the areas that we specifically concentrate on, and we're quite rigorous about that, the reasonable proxy is inflation plus a small amount. So that in turn reflects the annuity nature of what's being created. So that's really for us, that's what we mean, and that's why it's been attractive to Welcome. And I think you will see other people coming in, but you've got to get that certainty established in the first place, and that's one of the challenges, of course.
And you said, so we're talking about the context of strategic land and investment, and you think you'll see other people coming in. Do you think this form of investment in strategic land is something that's existed before, it just hasn't been taken up, or it's a new form of investment, a new opportunity that we're seeing coming to the forefront?
Well, yeah, as befits our new owner, it's a kind of rethinking, re-engineering of what was there before. Of course, strategic land is an old, is not a new concept, but did mean different things to different people. So the universities, and you mentioned in your introduction, so they've been long-term holders of principally agricultural land assets over centuries, some of which then over time get planning consent. And equally well, if you looked at the house builders, they had what they described as strategic land was essentially self-generated planning consents to go into their building pipeline. We rather started from a position of how can you harness the skill base that we had in doing some of the very large projects that you were kind enough to mention in the introduction. But how did you do that? How would you do that on a residentially led basis and on very substantial scale? Because what had been, and the rethinking or the re-engineering, if you like, comes from the fact that the house builders, I mean, we set the business up at quite a challenging time. So we were establishing a business that was very much designed around large residential assets when what had been known as the consortium sites were very unpopular with the house builders. So it was, people thought that was rather perverse, but it was very clear that you couldn't hit housing numbers in Southeast England without a greater reliance on big sites. So we had to re-engineer, and Mills Reeve have been with us since the start, so they know we had to re-engineer in order to make it attractive to different constituencies. And one of those constituencies ultimately was the patient capital, which we knew we could bring in, but that we could only bring that in. Some of you may have seen the hockey stick of investment that we show, because essentially our model involves investment on top of the land for 3 to 7 years, and then money back for 15 to 20 years. So it's a 15 to 25 year cycle, but there's no ducking the fact that you have to be able to invest without a cash return for that first period. And so that was one element. And that was moving at the same time as looking for the house builders. So what had happened with consortium sites? So consortium sites were promoted, and I bristle at the word promoting, it's banned in our office. They were promoted, and then when a consent was obtained, they would be sold off to a series of, in large parcels, to a series of house builders. The problem with that approach is that you're then only as strong as your weakest link. It's a bit like a lone syndicate. When you're the weakest participant, is that syndicate finishes up dictating the actions of the whole. So we were very clear that actually you needed to do the precise opposite, which was make sure that you had the strength to then go on and invest the front end on your own account and actually accelerate that investment. And so that was the re-engineering that we did. So we're not the first people in the world to get planning consents of the size that we do, although we obviously get more than our share. But it's unusual to have gone on to be in a position to fund the front of that spend and be selling licenses rather than normally cash disposals. We do the occasional land sale, but generally we sell under license to maintain that integrity of the developments. And of course, we've had in the process very considerable government support, because there's that in this instance, the alignment is not just with the likes of Welcome, but it's obviously very directly aligned with government housing priorities. So that re-engineering has allowed us now to create a model which others are looking to do. We would obviously be at the front of that. We've got more projects, conspicuously more projects than other people, but that's from our point of view, that an enlargement of the sector is a wholly good thing. So we are encouraging of more people coming in.
And if we just talk about that enlargement of the sector and we bring it to patient capital in the context of the recent purchase by Welcome, which I think many will see as a perfect marriage, because in Welcome what you've got is an institution with a strong track record of investment in alternative assets. And what you have in Urban&Civic, in my view, is you've got an entity with a track record of delivery and performance as an exemplar master developer. So you're taking the best of strategic land with an experienced investor looking for long-term returns for wider sort of benefit to the public in terms of their own injection of capital. Now, if I might, I think it was sort of well placed and said in the House of Commons on Monday by both Mark Pawsey and by Robert Jenrick, where they actually specifically name-checked both Halton, which I'm going to put my hand up and declare an interest, the first site I ever worked on from Urban&Civic, and also Urban&Civic's approach in terms of being carefully master planned, weaving in public realm. And actually, Robert Jenrick specifically mentioned the injection of capital by Welcome and how he saw that as being beneficial in delivering and the continued delivery of high quality, sustainable communities, which I think shows how patient capital in this sphere can bring all of those opportunities together. And in fact, if I might refer to one of your quotes, I'm going to have to read this. At the time the Welcome investment of capital broke, when interviewed, you was quoted as saying, "This is patient capital going behind a business model that is well established, generates very long returns, but requires supportive capital to help nurture the front end of our projects." So 3 points from that really struck me. The first is it goes behind a business model, the model you've just been referring to. Secondly, it generates very long returns. And thirdly, it nurtures the front end of your projects, all of which you've referenced so far. What I think I'd be keen to understand, and I'm sure everyone watching today, is what does that mean for Urban&Civic in taking it to the next level?
I need to just do that in 3 parts. So the first part of that is that if you look at historic institutional investment, quite often it was at the original, going back to this word that I dislike, promotion. So they were funding planning consents in the first place. That's a very bad place for institutions to be placing their capital. And that's why you need a business model. That's why you need people like us able to carry that front end risk. And the second, the rather good place for institutional capital is once those elements have been established and you are investing in making the place, and that goes on to the third element of this re-engineering. We've obviously ratcheted up the extent of that front end investment. So our normal presumption would be that we would build a primary school at the same time as the first houses are opening. Now that's partly to meet an educational need, but if you think about it, it can't possibly be the case that if you're doing that to coincide that you're meeting demand from your existing housing. So it's partly placemaking, and it's partly that broader contribution to the community. And you mentioned Halton, and Halton's a very good example where actually there's a considerable demand for houses, but an even greater demand for schools. And so being able to harness that capital at the front end has enabled us to produce a development which receives the commendations in the House of Commons, but is also sitting very directly now within that broader constituency. And we would do everything in that regard. So we've, as you mentioned, the primary school is already open, was opened by the Archbishop of Canterbury. The secondary school comes on stream in September. We've not yet got 1,000 houses built, although they're going pretty fast. And we've built a link road. We water the flowers, we plant the trees, we do all of those. We create those green spaces that the minister referred to. So that's obviously capital consumptive at the front, or capital demanding at the front end. Equally well, in the context of Welcome have a extremely strong track record in recognizing and anticipating moves in the market in alternative classes of investment. But we, I think, are really exceptional, and I know this because it's one of the drivers for why they made the acquisition in the way that they did, is that the ability to, if you like, realize value over time, which is your business model point, but by doing good in the process, building new schools, creating environments, is obviously extremely attractive to them. So realizing value for reinvestment in medical research, whilst at the same time building great new schools and helping meet what are enduring housing demands, is obviously a very good balance for them. But it won't just be them. And in relation to who might other people, I think over time you'll see institutional investment attracted by the annuity features. So Aviva are co-investors with us at Halton, but also the sovereign wealth and Canadian pension funds, those infrastructure investors. It's a logical place for them to go, but only when you're over the hump. And then there will also, I think, be other parties who are attracted by this doing good. So I wouldn't be at all surprised to see the likes of the Crown Estate, Grosvenor. Some of those, Grosvenor already do have some investments. I think there are those two different constituencies. Welcome are probably unique in spanning the two. Of course, they are much the largest endowment in this country, the second biggest medical charity in the world. So there is a very clear direction for us with them, which suits both of us.
And just to pick up on a couple of points there, you're talking about Welcome being unusual. They're investing for the full development curve. But you were then referring to there may be other investors who look to invest in strategic land as an asset class after the curve. For those, I'm sure everyone listening will know, there is a development curve which goes significantly down before it comes up. Do you see that there might be a difference between those who will invest in development sites of this nature what I call baseline and post?
Absolutely. And in order to do it you have to have the business and not just looking at that as a financial investment. You have to have the team that can do that. And as I mentioned before, one of the downfalls had been where people had just put money behind promoters, and they thought that they were having long-term investments, and it became rather a self-fulfilling prophecy because it stayed at the back of the drawer into the filing, and the next thing those institutions knew is that they'd spent £3 or £4 million and they hadn't got anywhere. So that risk is is rightly and legitimately carried by businesses, or maybe by organizations, I don't know, like for example the Crown Estate. You could see that would be a logical thing for them to do, but it's not logical for a Canadian pension fund to try and do that. They should invest once you're at the back end, once you're over the hump on the curve. And in those circumstances, the reasonable returns are lower, but they are, as I say, they're basically annuity. The reasonable presumption is that those returns are annuity plus returns. And in circumstances where the market craves that and there are so few index linked opportunities available, that's why I'm sure there will be this enlarging, because that's obviously a very attractive investment product. And at that point is essentially de-risked. So it carries a very different interest rate expectation than if you're
It goes back to this risk and reward, doesn't it? How much risk you'll take, how much reward you might receive.
Yeah, no, it is true. I mean, people rather take for granted, because we've had such an extraordinary record of getting planning consents, and we've got I would say, the best team in the business, and more experienced than anybody else, and of course more experience in negotiating Section 106 agreements and all of those things with your help, but all those things that we know are very time consuming and challenging, and you need a bespoke set of skills and a certain masochism to inflict that upon yourself in the first place.
And if we talk about sort of the next big thing, at one point, student accommodation was a very, very big alternative asset class to invest in. Do you think strategic land will gain that support in the same speed and scale?
It's a good question, and not to the same extent, because it depends what you mean by big. It will become substantial, but it won't be as large in relation to strategic land as, for example, student accommodation, because the figures are not. But I guess a reasonable presumption would be 50 schemes in Southeast England, and predominantly they would have to be in Southeast England in order to justify the front end investment. You need that population and housing demand. So if you thought that each one of those is £500 million, excluding the land, that would be 25 billion just in strategic land. And then there's that broader annuity spread in relation to infrastructuring. I think the same as you're seeing in strategic land will broaden up in other parts of property investment to look to create, where you can, annuity yields in circumstances where, of course, lease lengths, so those historic commercial leases, are just much shorter and rather riskier, of course, and retail would be a very good example of that. So the industry will have to again re-engineer and try and look to see how they can capture that capital, because by definition that tends to be the cheapest marginal cost. So you've got to look at how you can do that in circumstances where that's simply not going to be available within the conventional commercial rental structure that we grew up with.
So you've already identified, as part of that discussion piece, certain hurdles which might be hurdles to some people entering the market. For example, if you're at the start of the curve in a development cycle, it's the level of investment. You need to have that wherewithal, and also that longer term ability to wait for your returns. Are there any other hurdles you think that investors will be looking out for and be concerned about? And additionally, if you were convincing those investors to take a longer term patient approach, what would be the overwhelming benefit in them doing so? Thinking about their bottom line.
Well, so it is absolutely true that the, if you like, the barriers to entry rather than the hurdle, but the barriers to entry are clearly pretty high. You need to have, as I say, an extremely good team and a collective sense of masochism to get to that through those first elements. So in terms of seeking to encourage more money coming in, that's really a function of more projects. And so some of the representations that we've been making to government have been how they might encourage and get some further presumptions in the system, because again, historically, the time it's taken to put together and secure planning consents on large schemes is excessively long. And we are manic when public consultants, but equally well, you should be able to get a planning consent with all of the public consultation, with all the technical studies done in 2 to 3 years, whereas historically it's been 5 to 7. And that's actually just to get the planning consent, not to then start the build up. That's clearly too long because of and in terms of the viability of large scale residential development. If the local authority is always the competent planning authority, that could be 2 or 3 leaders. That's simply not practical. So we've managed to bring that, shorten those periods. So our average is now about 3, but there needs to be some greater presumptions on the part of government in helping push that. And in relation to I think off the back of that, and as it matures, then I think there will be more demand probably than there is supply, because there are the innate restrictions in supply that I was describing. I think I was quite clear with our shareholders, who I went to see when the welcome offer was announced, that my confident expectation was that the business would be twice as big in 5 years' time, but that was more likely under welcome stewardship, partly because they had some projects actually of their own that we were taking on, and there were 99.6% acceptances to the offer. So there's a well understood path now. It's really how you go about creating those additional opportunities. But if I looked at student accommodation, which you referenced before, if you think about what happened with student accommodation, it started, and I was part of this at the LSE. The original proposition is that institutions would only invest when there was a clear lease back to the university. And then that weakened, and they said, well, actually, okay, we'll do it if there's a nomination agreement. And now, if it's in a good place, they'll do it irrespective of whether there's any relationship with the university. And that's because the perception of risk has changed over time, but also because of the underlying dynamics of students and those supporting elements. It's exactly the same with large scale residential development, in the sense that once the hard bit is to get started. Once you are started, it will be increasingly seen that the risks attaching to the back end are relatively low. There will be, of course, periods when housing demand drops, but by definition, if you're an institutional investor, you can absorb a couple of years of that. And actually, the way that we have set the business up with licenses essentially underwrites a minimum level of income every year in any event. So it's pretty clear that that is an attractive model to investors once they are satisfied that the risks are manageable. And the best way of demonstrating that the risks are manageable, actions always speak louder than words, is to have a number that you can point to. And we're building now a clear portfolio of those slices, if you like. Welcome bought all of that in first instance, but that's not to say that at some point in the future we might not subdivide some of those. Welcome's had a very, very successful investment in student housing with Goldman Sachs and under IQ, which was sold recently, a very, very large, I think the largest single transaction probably, certainly in the UK. So that ability to, what we and Welcome are doing together is creating the presumptions and establishing the fact that the risks are low by demonstrating how over a period. Holton is a very good example. Holton currently in Rugby, there are considerable numbers of new housing developments in Rugby, but our customers tell us that, our house building customers tell us that they're selling houses at Holton about 2.5 times as fast as they do anywhere else. So those are the empirical demonstrations that you build over time, and we're building that catalogue now.
Comes back to this business model, doesn't it? Building your reputation on the back of it. Now, I've got lots of questions on my list, but we have got a lot of questions from people who are watching today. So I'm going to switch to some of those questions, if I may, because I'm sure people would like to hear your views on these. One of which was emailed in advance from a lady who you all know very well, and we've both worked with, Christine de Ferris-Green, and her question to you, Nigel. If patient capital is to become an established means of investment in strategic land as an asset class, what do you think the role will be for Homes England in the future? And following on from that, do you consider it likely or even possible that the government may expect the market to provide patient capital for housing and other long-term real estate investment to enable that funding given to Homes England to be redirected post-COVID in rebuilding the economy and investment in other sectors?
It's a great question, and Peter Freeman spoke yesterday, who's the new chairman of Homes England. Of course, they are re-evaluating their position. Nick Walkley has stood down as chief executive, and they've looked at 4 different blocks, really. So Help to Buy would be the biggest amount of money that they've been investing. So the amount there that they've spent under Help to Buy schemes is probably about 18 billion, something of that nature. It's a very considerable amount. Then they've been funding the likes of us through the couple of different home builders funds. We only take loans, not grant. So I'll come back to that. And then the third element of Homes England is that they have a fairly active, what they call master development program on their own. We call master development, and they've adopted that program on their own account. I think there will be a continual debate as to whether particularly the extent to which they do the latter. But I think the real challenge for Homes England is this area between grant and loans, because typically sometimes it's rather difficult to separate, and most people want grant for obvious reasons, and that's enabling, and they say that without grant we can't enable development. We would never ask for that. So we would only ever ask for loan funding on the basis it was accelerating, and I think they will keep that's rather an attractive proposition to Homes England. Actually paradoxically becomes more attractive as the stability of patient capital coming in helps underpin that area, because if you're lending money, the better the covenants, broadly the better that is. There is then, of course, the question as to why should you lend to the likes of Welcome at all, when they could afford not to? And the answer to that is, well, of course, there is an opportunity cost in that acceleration, there's an opportunity cost to Welcome in terms of the various alternatives that they have. And for us, the cost of that acceleration is one that we couldn't reasonably expect a institution to absorb on its own account. So we would still do things, but we would go slower. There's no question that our business model has substantially benefited from Homes England aligned lending, but equally well, there's also no question that there has been a benefit in terms of the acceleration and the public good and the things that we were talking about before. So I think there will be, I think I'm sure that there will be a continuation of Help to Buy in some shape or form. I don't think that will be, and that's what Peter said yesterday. It could well change so that it's some kind of mortgage guarantee, so rather than actual money invested. But I'd like to think that this alignment in relation to long money, so it's absolutely not the case at the moment that Homes England have been displacing other long patient capital. It's rather the opposite, which it's encouraging it through this stability and sense of direction that I was talking about before.
Thank you. I'm going to go to another question now, and apologies, I'm reading this from the Q&A, and this is from Craig. With a larger capital input at the front end and following a placemaking model, what sort of additional value do you expect when selling land of houses? And there's a recent statement here. Savills has published research quoting a 29% increase in land values at Poundbury.
Yeah, Poundbury wouldn't satisfy the Urban&Civic test in that it's the rates of delivery are not fast enough. So you need to have an absolute, you need to have a benefactor like Prince Charles rather than a commercial organization as we are to promote that. And it's rather difficult to separate the uplift in value from the accelerated pace of delivery. So we are more, the biggest priority for us is to make sure that there's a sufficient price level. So we would not normally be interested in areas that are below about £225 a foot. And the reason for that is only because of the fact that it's not some rapacious, it's that that would be a proxy for a level of demand. But the bigger point for us is that even we wouldn't be interested in a high value location where we thought that the level of absorption was very low. You need to have the combination of price and absorption. So there clearly is a premium in terms of placemaking. Really hard to judge, but maybe 10% in first instance, and it's not a one-off. It accretes over time. But the second and really and reinforcing element is that the pace of delivery, we probably run about twice as fast on our projects as old-fashioned consortium sites. So that's and that of course of itself contributes to that placemaking because you establish a critical mass earlier. A lot of the demand, the other supporting services come in more quickly. So and people are pioneering, and of course one of the other elements for us, which we haven't talked about, but a crucial part of the Urban&Civic model is that there are never any construction lorries that go past existing occupants. So we always put in haul roads from the back. So there is a premium, but the real point is the accelerated delivery.
Thank you. I think we've got time for one more question because I've promised a 10:45 finish, and this is from Martin Valentin. And he says, we Positive Homes are currently bidding for a part of UNC's Middlebeck site in Newark. Would be a net zero carbon scheme, which matches Urban&Civic's values very strongly, fingers crossed. Nice plug, Martin. Where do Urban&Civic see themselves going forward as a promoter of net zero, safer neighbourhoods, electric cars, etc.? Great question.
Well, I mean, we aim to continue. We already are ahead of the curve in that regard. Witness the Secretary of State's comments, and the drivers for that will maintain. So we will go as fast, but equally well, it's partly as fast as our customers go too. There's a leadership role that we can take, but it's not a haranguing one, and it partly reflects the So the example I always use, our developments, it's not that difficult, candidly, for on very large developments to achieve quite considerable environmental uplifts, which sounds counterintuitive, but if you think about it, it's obviously the case, because you can build in things at the start that you can't do on infill land. But then there's, in relation to the house building itself, the example I always use is showers. You know, if people put, if the builders put water restrictors on the showers, the first thing the customers do is take them off. So you've got to balance up those elements. And we already have a number of house builders on sites where they are where they're very specifically in their product aiming at a net zero carbon position. But I look at it as the whole. My starting point is the estate, and then the constituent customers within that estate. And for the estate, we're very, very committed on those elements and leading the way. And again, just to finish off, because we've got more sites than other people, what we have got now is a very rigorous quantification, which we're building up over time the evidence that shows this is how you go about it. This is the route map of doing it, and these are the outcomes that we are able to demonstrate. So again, there is an advantage from market leadership, but you've got to keep going.
Nigel, thank you. I have got a number of questions which are in our Q&A, which I will follow up with you afterwards. It's been an absolute pleasure. Thank you so much for being my first on my virtual sofa. I hope everyone listening enjoyed that as much as I did. As I say, there are 3 more coming up in the series. Next one next week is on the stewardship model, where Gail Mayhew and Charlie Dugdale will join me. And then there'll be the following 2. It'd be great to see virtually as many of you as possible. And just lastly, before I let you all log out, please, I would appreciate you taking the time just to give your feedback when the form comes up. So enjoy the rest of your week, and many thanks for joining us this morning.
Thank you very much indeed.
Thank you, Nigel.